Think we're ready to get started. You ready, Tag?
Yeah, let's do it.
Got it. All righty. Welcome, everyone. I know many of you are either current clients or new possible clients, so welcome. Thank you for joining. A little bit about Optimized Payments. We are a fintech firm purpose-built to help merchants find and unlock hidden value in their payments ecosystem. We have quite a deep level of expertise within our company, and we like to partner with our clients to help them achieve measurable results and savings, whether that be an interchange analysis, a possible fee reduction, or with our analytics tools. We truly partner with our clients and we try to help them negotiate possible savings, and we want to achieve measurable results. A little bit about myself. My name is Tom Wrigley. I am based out of Chicago. I've been working with Optimized Payments for about a year now. I made the switch from banking last summer. I couldn't be any happier with this company to work with people like Tig each and every day. I specialize in interchange analysis, and I'm excited to show you what we have to share today. Tig?
Yep, thanks, Tom, and thanks everyone for joining and taking the time out of your day to listen to our webinar. My name is Tig Caldwell. I'm a senior payments consultant here at Optimized Payments. I've been with Optimized about a year, but prior to here, I worked about 12 years at a large payment processor, focusing on interchange analysis, cost reduction. So today's topic is one I spent a lot of time in, and interesting. Looking forward to sharing our findings with you guys. So.
Absolutely. I think we're about to send a poll question out right now. So that should pop up on your screens.
Yeah, there we go. Great. So has your company felt the impact of recent card brand pricing changes? So a lot has happened, right, specifically in the last 2 to 3 years when it comes to card brand pricing changes, right? Visa, MasterCard, and others have pushed out significant changes, notably back in 2020 to 2022, and a few changes in the last year. So just curious how the group is, right? Have you felt those recent card brand pricing changes in your business? And while you're responding, right, so the title of this, right, we're looking at a 10-year look at card pricing changes, right, focusing really on cost, interchange costs and card processing costs, how they've changed over the last 10 years, right, what's obvious change, what has gone on behind the scenes that maybe you're not aware of. So that's what we'll be looking at today.
It appears 87% have seen change. Tig.
Okay, yes. Wow, so yeah, a little higher than I would have definitely guessed. The majority, 87, is higher than I probably would have guessed. So that's good. That tells me that everyone is right attuned to their costs, right, looking at the costs, and you would have felt the changes. If you're looking at it, you would have felt the changes in most cases. So, all right, you want to jump to the next one, Tom?
Absolutely.
So first part is looking at what has changed, right? The public changes that have come out recently are obvious, more obvious, I should say, right? And you know what to look for, you can quantify these. So again, 2020 through 2022 were significant changes, but I just want to touch on what came out this year, right? So April just passed, right? April is the time that the card brands really pushed through their price changes for the year. So this year, generally, they were minimal, right? Especially relative to previous years. So I just want to highlight some notable changes that you may have seen. Your acquirers probably made this aware to you guys, right? If you've worked with us, we would have mentioned this with you guys too, but Visa introduced a new CVV2 fee, so it's a quarter penny that they're tacking on to any match or no match. That started April 1st. They also introduced a mag stripe data fee, so if you're still using that, on April 1st, they're hitting you with a 10-cent fee. The incremental auth fee, new from Visa, of 2 basis points. That's also on estimated authorizations as well. So if you are in a line of business that's doing estimated or incremental authorizations, there are a few exempt industries. Fuel's one notable one that is exempt, but you could see a 2 basis point fee on those incremental or those estimated authorizations. And in some verticals, some industries, that is a very significant fee change. Many others, right, you won't even notice it. You don't have that impacting you. MasterCard made a few changes. Sorry, Tom, go back one more.
Ooh, my bad.
Yeah, MasterCard's made a few changes to some of their assessments fees. Notably, they increased their excessive auth fee. It's 10 cents currently. They increased it to 15 cents earlier this year. And then they put forward a path for changes for 2 future years. So it's going to be all the way up to 50 cents per occurrence in the year 2025. And again, this fee applies if you retry a transaction more than 10 times in a 24-hour period where the issuer has declined that transaction. So this is a fee, right? This is a fee that could be avoided, could be managed if you're managing your decline logics or your retry logic as well. So, and then lastly, the MasterCard authorization optimizer fee. So a 2-cent fee, only in the card not present, where you get an NSF return. So, or sorry, NSF decline. All right, next time. And then interchange wise, right? Again, relative to previous years, interchange changes this year were relatively minor. Discover increased their network integrity fee. That's basically their surcharge on a downgraded transaction from 5 cents to 10 cents. That matches what Visa has now. And then interchange wise, really the only interchange changes of note, right? There's a lot of changes that went through, but the ones of note were Excel and Star. Made a variety of changes. Excel increased QSR. They made some changes to their pinless programs. Impacts there is going to depend on your payment size. Then Star made a subtle increase to the restaurants, and they also increased their small ticket programs as well. So again, all in all, especially relative to previous years, probably pretty minor. Some clients, some industries will be a little more impacted than others, but generally minimal is how I would classify these. So, and then just kind of keeping network changes increases in mind. What are some best practices, right? So throughout this presentation, we're going to kind of layer in some best practices, and we'll cover that at the very end. But given all this is happening, right? You know that Visa, MasterCard changes, network changes are always going to happen, right? They happen this year, they're going to happen in the future. What are some best practices you can do? The biggest thing that comes to mind is be able to track and manage your fees through analytics, right? So if you can, the first step in being able to manage any kind of changes is be able to measure it, right? So if you can't measure it, it's tough to manage. If you can measure it, right, you can go through your data, know these fees that are changing, see in your data how much volume you have in those particular categories. You know, it's relatively simple to quantify from there. So being able to be a kind of a master of your interchange and payments data helps not only this, but helps in many other areas as well. So, all right. Excuse me. So that was this year. So then getting back to recent years, right? So this is going to be probably very common knowledge for most of you now, but back in 2020, right, Visa in particular, MasterCard and the others as well, put through what were called at the time the most significant rate increases in decades. So I clipped out a few of the newspaper headlines from the time, right? So front page of the Wall Street Journal, Bloomberg, et cetera, right? Very impactful to the industry. Most merchants, or if you go back and read through those, were expected to see about a 5% cost increase. That's on average across the board. Some would be higher, some would be lower. A few, right? So large grocery actually saw decreases, but that was kind of the exception to the rule, right? If you go through those bulletins of the price changes, lo and behold, right, most of them are going to, most industries, most merchants would have seen a cost increase. Those were announced in early 2020, right? And everyone knows, like, COVID hit right after that happened, pushed a delay to a lot of these rate increases. A few went through in 2021, but most of them didn't end up going through until 2022. All right, next time.
Absolutely.
And then, yep, so what were those changes, right? So I won't go through all of them, right? If you go look at some of the bulletins that came out from the acquirers, they were 40 pages long, but in a nutshell, some of the highlights were Visa overhauled their card not present business card rates. So they increased those from 25 to 40 basis points, right? That's a significant change that impact every merchant, right, that accepts card not present business cards saw that impact. At the same time, they also increased their consumer credit card rates about 9 to 10 basis points. I will note that they also put out a new tokenization rate that could essentially wipe out that 10 basis point increase where you start utilizing the Visa tokens. But even without that, right, they did push through that 9 to 10 basis point increase in the consumer credit cards. Restaurants saw some significant increases, right, up to 56 basis points increases that happened back in 2020. MasterCard joined along too. So their consumer credit cards, both in the card present and the card not present space, increased in almost every category from about 5 to 15 basis point increase. Discover, similar, right? In most categories, Discover were up 5 to 10 basis points on credit cards. And then in addition, those are all interchange changes, but there were some other network and assessment fees that were increased or introduced during that time frame. There were more than one. I just noted one was more the significant ones was the MasterCard digital enablement fee. So in card not present space, they increased that fee by a basis point above where it was. They also restructured how it's priced, right? So there's a minimum, a maximum fee on it too, but that was probably the most impactful single assessment fees. So again, so this all happens for public knowledge, right? What can be done, right? So you can't really control a lot of these increases that come through, but you can look for ways in your business, in your processing mix, right, to kind of optimize the volume that you have, right? So for example, that first bullet I touched on was the card not present business cards from Visa, right? So business cards have the ability to get lower rates called level 2 and level 3 rates. Say you don't have level 2 or 3 today, where you introduce or achieve the level 2 or level 3 rates, for example, you could erase that business card increase that happened. So, and then tokenization, I already mentioned tokenization, right? Visa increased consumer credit cards and card not present by 10 basis points. At the same time, they did introduce this new tokenization program. That right, you got to take some steps. You have to implement it. Right, there's work to be done there. Usually, a price to be done, paid as well. But by doing that, you could remove that 10 basis point increase. Right, and some merchants that have a lot of volume in that space, tokenization is worth millions of dollars a year to them. So that's what we know about, right? So that's the published rate increases. Right, people are familiar with that. But at the same time, and what we want to get into in this presentation is there's other dynamics that are going on in the industry for the last 10 years at the same time that have as big or bigger impact as the published rate increases that we've seen. And Tom's going to get into a few of those slides now.
Absolutely. So a few of these card type shifts are impacting costs, and the merchants aren't necessarily publishing them. So merchants aren't able to see these shifts. Issuers have stealthily been issuing more expensive cards. When it comes to the data that we're looking at, we have data going all the way back past 2010. So we're able to look at a decade of data and analyze that over the years. Much of this data, you can't really see a shift year after year. You have to look at it from a more broad point of view. But when it comes to both Visa and MasterCard, Visa has 4 tiers of interchange levels, or card levels, I apologize. And that would be traditional, rewards, signature, and signature preferred. And then MasterCard has a base level all the way up to World Elite. So with those different tier levels, merchants are going to be charged a different interchange rate. So the trend that we've seen from 2010 to 2020 is that, this is just a Visa graph, by the way, is that Visa is issuing more Visa Signature Preferred to its customers, and those cards are associated with higher interchange rates. So the less signature that merchants are seeing, the more they're going to be paying in interchange rates, basically. Ty, do you have any other insight?
Yeah, great points, Tom. And you can see how subtly it's changed over the years, right? If you look one year versus the last year, you probably won't even notice it. And another thing about this, right? A lot of people don't even look at their data at this level, right? You probably, if you're tracking anything with mix, you're tracking maybe debit versus credit cards. Maybe you're looking at commercial versus credit versus debit cards, right? And you may look at those rates and you see that nothing's changed, right? My debit mix has not really changed at all over the years. That's good news for me. True, your debit mix hasn't changed, your credit mix hasn't changed, but if you look at the types of credit cards you're getting, and if you have the data going back, right, more than a couple of years, you would see this in your data, right? You would see that if you go look at that Visa Signature Preferred card, that MasterCard World Elite card, if you look at your statement right now, I bet you it's your largest single commercial consumer credit card. If you could find a statement from 5, maybe even 10 years ago, you would see that it was much smaller than it is today. So it's buried in the data, right? It's not an area of mix you typically would look at, but it has been occurring, right? Like you see in this graph, like Tom mentioned, over 10 years, slowly and steadily been increasing. And the next slide Tom's going to get into is, right, shows you what that mix has done to price, what it's done to cost, and how the rate changes kind of impact that as well.
To add to that, commercial cards have been following the same trend. Visa and MasterCard have created more tiers for commercial cards, and that's just increased the interchange that merchants are seeing for each commercial card that they're taking as well.
Yeah, they've introduced, they're up to 5 tiers. So if you look back 10 years ago, right, most commercial cards that you would have gotten would have been kind of corporate or purchasing cards. Those are cards, I think they're priced at like 2.6% 10 years ago. I think they're 2.7% now. Those cards are also level 3 eligible. So you can get if you do level 3, you can get under 2% rate on those. Again, 10 years ago, that was the majority of commercial card volume. If you did it, we could do a graph like that on commercial, just like this. Now that you see those are the minority cards, right? So most commercial cards now are what are called small business cards. You see them, like Tom said, tiers 1 through 5. And tier 5, right, is a relatively new tier from Visa and MasterCard. Those are priced at over 3%, right? So again, it's a lot of volume going in there. They've introduced new tiers. They're pushing more and more volume into those higher tiers. So tier 5, I don't think is the highest volume tier now. If you look at a statement, it's probably tier 3 or 4. You see most of your volume, but still, even those cards are almost 3% in cost. So,
and they're not publishing the amount of cards being issued out. This is just completely secret.
Yeah, you can only see that in your data, right? You have to know, look in your statements, be able to identify those exact card types, right? And then kind of build a graph like this so you can see how much volume, whether being commercials in each tier or in these consumer credit cards, how much volume you have in SIG Preferred or World Elite versus kind of more traditional base cards.
Mm-hmm. I'm going to move on to going into interchange rates. So another variable contributing to the cost of acceptance would be interchange, of course. Interchange rates are generally increasing, and I think that's a pretty big industry standard that we've seen, is that interchange rates increase year after year. For retail per se, from 2010 to 2022, we have not seen much of an increase in retail. Restaurant rates, of course, have increased. And we see commercials all the time for cash back at certain restaurants, 2% cash back, 5% cash back if you go to a restaurant. What's paying for those rewards is the interchange that they're charging the merchants. So that's why restaurants have such a large increase in their interchange. For grocery, it's a little bit of a mixed basket. We've seen a reduction in interchange for signature preferred, but an increase for the classic card. And that'll play into something a little bit later. For e-com, an increase in both interchange rates for signature and signature preferred as well from 2010. But the credit card mix also plays a big role into this as well. It almost plays a larger role than interchange itself. If you look at the restaurant rate of 2.6%, 59% of credit cards are now receiving that rate. And that is not doing merchants any favors, in my opinion. I think Ty would agree with that. They need to pay for the rewards, basically, at the end of the day. And that's what these signature preferred cards are doing.
Yeah, Thomas, next few slides will tie the two together, but look at just restaurant, for example. 60% of volume now is paying a rate of 2.6%, right? If you went back 10 years ago, right? Signature, that middle row is the dominant card, 66% of volume was paying a rate of 1.90%, right? So it's kind of the two go hand in hand, kind of a double whammy of cost, right? You're paying a higher cost rate, published rate, and you also have more cards now paid at that higher rates.
So for example, even though retail interchange rates didn't increase from 2010 to 2022, that credit card mix that we've seen has changed in a way that it increased retail costs 10% in that 10-year span. We looked at a merchant with an average of $50 in payments and then a 50-50 debit and credit mix. But that credit card mix that we're seeing just to signature preferred is really driving the increase in cost annually. And the same holds true for restaurants as well. So restaurants, we've seen an 18% cost increase just because they've had an increase in both interchange and the credit card mix to signature preferred. So like Ty was saying, double whammy, you're getting docked on the interchange increase and the credit card mix. It's not going to prove beneficial for the cost in the long run.
Go back to one slide real quick, Tom. I just want to make one
Absolutely,
point. So
Ty.
retail is a great example, right? So you look at the interchange rates on retail, they have not changed at all, right? Tom mentioned it earlier, over the last 12 years, right? So the networks are out there touting, right? We haven't touched retail rates at all over this time period, which is true, but they're not telling you, right, how they've increased so much more volume, issued so many more cards into those higher cost programs, right? That they don't have to publicly increase the interchange rates. They're getting more interchange revenue just by the cards that they issue, right? So again, 10% increase, right? Your mix may have never changed, your average ticket may have never changed, right? But you're still paying 10% higher on average, just because of that card issuance shift behind the scenes.
And the same would hold true for restaurant as well, but you're getting the interchange increase as well, correct?
Yep, absolutely. Yeah. So you're paying the higher rate, and you're also paying the higher. You have more cards paying that higher rate. So
Yes.
which is why you see a cost increase almost double what a retail, right? So you see that's where the double whammy I'm talking about. You're paying both the higher interchange, and you're paying more cards. You're receiving more cards on that higher interchange program.
Going into the grocery industry, we've seen that interchange fluctuated from classic going up in price to signature preferred going down in price. Either way, it didn't play a major effect into the total costs because that card mix, once again, comes into account. Signature preferred increased substantially, creating a cost increase of 11% over the 10-year span. And grocery cards are different in a way, correct, Tig? Because larger rates, larger grocery stores are charged more favorable rates. But since Visa and MasterCard has made it more difficult to obtain those rates for different grocery stores going forward, this creates a wash for the card mix, especially when you take the increase in card mix into account.
Yeah, exactly. Groceries, a lot of nuances to grocery, right? There's 4 published interchange categories or tiers for grocery, right? So what you're seeing here is the base level rates. But what Tom was mentioning, right, is the decreases in interchange are actually significant on the higher tiers. But even though the published rates may have decreased, right, this card issuance shift that we were talking about over the last 10 years essentially has washed all that out, right? So if you were to do this graph and this calculation on those higher grocery tiers, you get about a 0% cost increase over 10 years, right? Where as you would have been, if you just look at the published rate, you would expect it to decrease, right? So all the benefit they've given you really almost a wash, right? It washed out with all the increasing card issuance. So, and like Tom mentioned, right, they've increased the threshold to attain those higher tiers. So made it harder to achieve those lower rates at the best tiers.
And the last industry we're going to look at is e-com. Follows the same exact trend, but we've seen an increase in both interchange and that card issuance to signature preferred. So it's a 13% cost increase over the last 10 years. Just follows the same exact trend that we've seen in the restaurant industry, that we've seen in the grocery industry. The card mix increasing is going to lead to a cost increase overall. Overall, one of the best ways to prevent this going forward, or to prevent and help your costs from increasing, is to optimize debit routing. Go to pinless debit networks, analyze different avenues that you can have for PIN debit as well for card present purchases, and then avoiding downgrades. So I know Tig brought up that transaction integrity fee with Discover and Visa earlier. That's tacked on to downgrades that you may be receiving that you aren't aware of. If you avoid those downgrades, you're going to have a better cost reduction going forward. Any other insight from you, Tig?
No, that was great, Tom. So especially in ecom, right? So we don't really get into this much on this presentation, but in ecom, right, in card not present, debit routing, right, starting in about 6 weeks or so, July 1st, it's really going to start opening up, right? There's a new Fed ruling that's going into effect in July that's going to start opening up debit options in the card not present space. So very topical point there, Tom.
Absolutely.
Okay, so that was one major idea, right? It's been happening over the 10 years is kind of how the card issuance have shifted, but we also see one other kind of more macroeconomic dynamic in play, right? And especially in recent years, and that's what inflation has done to shifts in credit and debit mix. So we'll go to the next one, Tom. So we can see, right, we see in the news all the time, right, inflation has dramatically increased over the last 2 years. So that blue line I have on the graph is the inflation rate back to January of 2021. So it was historically around 2%, right, in early 2021. You can see it really start to increase, peaked around 9% early in 2022. So what impact does inflation have on consumers, right? So they have more expensive goods, right? More expensive goods. Consumers are going to be more inclined to use credit cards in lieu of debit cards. Also going on during the same exact time period was the whole COVID stimulus. So the last COVID stimulus went out in early 2021. So if you're a merchant, right, if you look back at your debit credit mix over the last couple of years, you would have probably seen your highest debit mix ever around those COVID stimuluses. So in 2020 and early 2021, right? Almost all of our clients saw peak debit mix in that time frame, right? So high debit translate to lower interchange costs, right? So more debit, cheaper cards, lower interchange expense in general. That stimulus ended in 2021. Inflation, right, took off about the same time, right? So those two working together drove down debit mixes for clients or merchants over that time period. So that's the orange line you're seeing there. So that's looking at our interchange data for our clients. And we saw on average our clients' merchants debit mix dropped by about 7 points over that 18-month period. So, and I'll note that every single merchant we looked at in our database had a decline in debit mix. All right. So if you're looking at your data and you're seeing why is my debit going down so much, this is most likely why, and that you're not alone, right? Everyone else is seeing the same impacts as you, right? Consumers don't have the stimulus money anymore. They're getting hit by inflation. They're using credit cards more often. So what does that do to card costs, right? So increases in credit mix are going to increase your card costs, and we saw that 7-point decline in debit mix over this time frame increased our clients' overall card expense around 4 to 7%, right? So definitely a significant number driven by just the way consumer behavior is, the way they're using their cards.
Would we say the debit mix is back to pre-COVID levels now, Tig? Or how would you analyze that?
Yeah, definitely. It's definitely back, right? The peak, if you will plot this out over a longer period of time, right? That peak, you'll see it obviously, right? In 2021, it's a dramatic peak. In some merchants, right? It's a very dramatic peak. It's definitely back to historical, and in some merchants, right, it's even going to be lower than that, right? The inflation, the impact that consumers are feeling from inflation is real, right? It's felt across many merchants, right? It's a real thing people are facing, and they are using more credit cards relative to debit cards because of that, and it's proven out in the data. So.
Thank you. Thank you.
All right. Do we have a poll question here, Tom?
I believe we do have another poll coming out right now.
One more. So while we're pulling that up, so we're going to get, all right, so here's the poll. Do you think total card acceptance costs are higher or lower now than they were pre-Durbin levels, right? So 2011, right, was right when the Durbin Amendment went in place, significant cost decrease. So our card costs, do you think they are higher now than they were before that happened or not? So I'll give you guys a minute to answer that. And while you're answering, right, so this last section, we're going to pull it all together, right? So we built kind of a model that's going to pull all these areas we've talked about and plot that cost percents over the last, plot that in a graph over the last 12 years, and we can see exactly the answer to this question, right? How have costs changed? How much have they changed? When have they changed? So.
All right, I can't pull the poll over to the screen, but we're at 100% of a yes response from what I'm seeing. Yes.
Okay. Well, smart group. So I'll say, so kind of the idea of this whole topic was, one of my colleagues mentioned to me, like just kind of offhand, that, that card costs, right? Visa and MasterCard, the card brands have recouped all of the money, the revenue, interchange revenue they lost from the Durbin Amendment. And that kind of caught me off guard. I'm like, there's no way that happened, because I started in payments right when the Durbin Amendment happened. And I remember what a significant decrease in cost it was. And just to hear that they've recouped all of that lost revenue over the last 12 years, that kind of caught me by surprise. So what led to this, kind of dug into the data, and really, like the poll respondent said, really proved it out in most cases, right? In most industries and most businesses, costs are back to pre-Durbin levels. So yeah, so now we're going to take the three things we talked about, right? So we know the recent published interchange rate increases, right? That's public knowledge. We talked about the issuer shift, and we have the recent inflationary pressures, right? So tying all that together, what has happened to card costs over the last 10 years? If you want to go to the next one, Tom. So this graph you see, and this is for retail. So I took an average retail merchant, right? Built a model based on the historical rates and our internal data and plotted what the average cost would look like over the last 12 years. So if you go back to 2009, 2010, before the Durbin Amendment, again, this is a retail merchant, $50 average payment and a 50-50 debit credit mix, just to keep it simple. That merchant would have paid all-in costs around 1.60%. That's total processing costs, interchange assessments divided by total sales, so around 1.6%. Durbin Amendment happens in 2011, so you can see, right, significant cost decrease there. But then you can see over the next 10 years or so, right, that gradual increase in costs, right? So that's new fees coming in from Visa, MasterCard, right? So the FANA fee, the fixed acquired network fee was a big one. You're probably familiar with. That happened in 2012, I believe. That's why you see that significant jump right from 2011 to 2012. But then over the next 10 years, right, as that gradually increases, right, that's from that graph that Tom showed earlier, right? You see more and more cards go into higher cost card types over the years. Slowly is going to increase your costs, right? Through that time too, right, the networks have increased their assessment fees by a few basis points. They put in other random fees as well. So all those things put together in the model produces a trend line like this, right? So that 10-year window or so of increasing costs. Then you get to COVID, right? So the stimulus I mentioned about the debit mix went up significantly. So you saw a slight reprieve in cost. That was only temporary, about a year to 18 months. And then once that ran out, right, we had what we talked about, the published rate increases, and that went in mostly in 2022. And then you had the inflation shift I mentioned a while, right? So that's why you see that line really start to accelerate in the last couple of years. So put it all together, and then you see over a long-term trend, a long-term window, you can see that now the average retail merchant's card cost as a percentage of total sales is typically going to be higher than it was 12 years ago before Durbin. So again, this is, again, just a model for 50-50 debit mix, right? Your mix may be different, your average check may be different, but if you were to plot your data, you would see a trend line very similar to this, right? You see a big decline with a slow increase over time, probably getting you to a point today that was at or higher than we were back in 2011. This was retail, Tom. So I did two other ones. I did e-com on the left, restaurant on the right. Again, there's a lot of other merchants. I know merchants on this call that aren't in those industries, but you can see the trend line on all three graphs is the same. And in your industry, I could bet you it's probably the same as well. Maybe you're a little higher, or maybe you're a little lower than you were back pre-Durbin, but the trend is going to be the same. You're going to see a slow and steady increase over time, kind of from all the things we talked about. On the left, e-com, right, you can see a very big decrease from the Durbin Amendment. So e-com debit rates in particular were much higher than retail, so that's why they got a bigger benefit from the Durbin Amendment. That's why you see a big decrease there. Again, slowly increasing over time. You saw this COVID stimulus, then the acceleration, right, in the last couple of years. E-com in this example is a little lower than they were pre-Durbin, but still, right, most of those Durbin savings have been eroded over time. Restaurant, Tom mentioned, right, really got hit by the published rate increases. They had the same underlying card issuance shifts. You can see how much it's really taken off over the last couple of years. That's mostly from the published rate increases. But your typical restaurant merchant is going to be paying more as a cost percent now than they were 12 years ago. So again, I think, right, what you're gonna take away from this is, right, the long-term trend line, right? I've been in payments, right, like I said, right before the Durbin Amendment started. I had never even thought of looking at a graph this long, right? You kind of get stuck in your just kind of recent memory, your recent comparisons, right? A lot of us will only compare year over year. So we know costs have gone up a little this year, right, versus last year, but you kind of get stuck in that tunnel vision. You lose track of the bigger picture, and this is the bigger picture here, right? So when you step out of the trees, look at the forest, this is kind of what's been happening. And probably not too much of a surprise if you really sit back and think about it. But it was a little surprising to me just to see this in a graphical form prove out in the data. And it's just, I don't know, it's just a striking graph. From just my history in this data, it's very interesting graph. So.
And to look at this graph, you have to really zoom out. You can't look at it year to year, is what I'm taking away, Tig. If you are looking year to year, you're just seeing a gradual shift, which doesn't really doesn't necessarily mean that it's increasing over time. But if you really zoom out, you can see the true increase from what I'm taking away.
Yeah, absolutely. Yep. I think that's the one, probably if you take away anything from this, right? If you think about this a couple of months from now, I think this is what I would want you to remember, just how much it's changed over the last 10 years and how much of this kind of is hidden, right? You wouldn't even thought about it, right? You wouldn't even be really aware of those card issuance shifts. Where you put it all together, you see, wow, what a big impact it's had to my business over the last decade plus. So, all right, I think that, yep. So that is all what's happened, right? That's kind of what happened in the industry. That's how costs are changing. What can be done about it, right? So if you go to the next one, Tom. Right, so a lot of this stuff, right, you can't directly manage, right? It's hard to control what kind of cards your consumers are using, right? They're being issued more signature and World Elite cards, right? It's hard to really stop them from using those. You can't really fight the macroeconomic trends, right? You're kind of at the mercy to consumers' behavior there too. You're at the mercy many times to what the networks are pushing through as card increases, right? But given all that, what can you still do to kind of do the best you can to lower your card processing fees, right? So there are things you can do, right? The biggest thing I mentioned at the beginning, right, is to be able to track and manage your fees through analytics, right? So be able to really become a master of your data, be able to track some of these key metrics we talked about, right? You don't have to go into the card issuance level that we talked about, but at least being able to measure your payment data, right, at the mix of credit versus debit and maybe even commercial rates. So if you can just measure that main KPI, right, that's going to tell you a lot about kind of your cost history, right? So if you see your volume moving more towards credit, you can probably expect your cost to increase, right? And then vice versa. Again, be able to track and manage gives you a lot of information, right? Can I help you manage your business? And when these changes do occur, it kind of helps you to be able to quantify those. So the recent network changes that came out over the last few years, right? If you're in tune with your data, right, you can be able to, right, fairly easily quantify those changes based because you have the information at your fingertips, right? You can know what those changes are going to mean to your business. And with that information, right, then you can do a lot with, right? You can kind of brainstorm or kind of pursue other ideas that may kind of counteract some of that. So that would be the biggest thing, right? And then ensuring that all your interchange fees are optimized, right? So you can't control a lot of things I mentioned about, but there's a lot of stuff you can do to interchange, to card processing that can influence the fees that you are paying. You can avoid downgrades, right? Those downgrades are penalties that the networks hit you with if you don't adhere to their rules on transactions. In commercial cards, I mentioned this, you can do level 2 and level 3. So that gives you lower rates on commercial cards. Can help counteract some of the fees that Visa and MasterCard have put in. Tom mentioned this, right? Debit routing, pinless debit routing, right? Are you doing all you can to optimize your debit rates, right? We didn't really focus on debit here too much, but you can do a whole other presentation on debit routing, how you can optimize debit savings. Always an important area to look at, particularly now that I mentioned, right, the Fed ruling going into effect the next few weeks. And then tokenization, right? Visa tokenization, mentioned this earlier. Through all those increases, right, they did throw in that little nugget, right? If you do use the tokenization service from Visa, you can see some significant savings there as well. So again, there's a lot that can go into all these, but really it's understanding your data, being able to measure it, and being able to know what you can do to optimize and lower those interchange expenses.
Going into the level 2, level 3 processing tag, that relates to a question Greg just asked a little while ago. With level 2 and level 3 processing to mitigate corporate card expenses, is it helpful just to submit it when you have the ability to, or what's the process of level 2, level 3 processing look like?
Sure. Yeah. So level 2 is basically just sending through the sales tax on the transaction. So Visa, I think, needs a sales tax amount between 0.1% and 30%, MasterCard 0.1 and 22, or maybe it's vice versa. But yeah, so basically the sales tax amount's got to be under 30% of the payment transaction. As long as you send that amount through in the transaction record, there's a little more to it, but essentially that's all you need to do is send through that sales tax amount. If that amount is in the transaction record, you'll get the level 2 rates. Level 3 is a little more complicated, right? There's probably half dozen to a dozen fields that need to be populated. They are kind of transaction, kind of goods and services focus, right? The quantity, the amount, the code, those aren't really policed, right? You can put through, as long as you have a value, I'll say this, as long as you have a value in those fields, you'll get the level 3 rates, right? There's no one going through and policing that. So a lot of people will kind of put static values, like 1 is the quantity and the code can be any number, right? Things like that. So the key really is finding a way to get those values into the transaction flow, right? So as long as those values are there, then you'll get the savings. Hopefully that answered the question, but that's really, it's, if you have it, obviously send it through. If you don't have it, there's ways you can look to kind of plug it into the data too. So,
You go to your processor for that, correct?
yep, yeah, I would recommend talking to us, talking to your acquirers. Yep, can give you some more insight there.
Got it. Thank you. All right. I believe that was the last slide. I think we're going to answer a few questions now that I've received.
Sure.
And we can go over those if that sounds all right with you, Tig.
Yeah, let's go for it. Hopefully you got a few good questions.
Absolutely. The first question that I have for you is, will the government step in and regulate credit card rates like they did with debit cards back in 2011?
That's a good question. So very good question too. Topical question. So just a few days ago, maybe even last week. So I don't know if you guys saw that in Canada, right? The Canadian government struck a deal or did a deal with Visa, MasterCard to lower credit card rates up in Canada. I think that goes into effect next year, but that is a step in the right direction, I would say. I think I read one of the articles I read, right, kind of gave hope to the US that maybe something like that could happen one day in the US. But to date, it has not happened. In the US last year, right, so Senator Durbin, right, from the Durbin Amendment, tried to push through an act, right, it's called the Credit Card Competition Act, I think it was called. Try to get that through last year. That didn't really regulate credit card rates, right? But it kind of took his path that he did with the Durbin rates back for debit cards back in 2011. It looked to open up competition, right? So he wanted to open up more networks, more credit networks on each card, and add in more networks, right? The hope there was that competition would increase, lead to lower costs. That didn't get through last year. I haven't seen much action on it this year, but again, it's a step in the right direction, right? Even though nothing has come of it as of yet, but that's kind of what's been happening so far in the credit cards. That's not a right. It's not a regulated rate. It's not a capped rate or a fixed price rate. But it looked to lower credit card costs through competition. Again, something to keep your eye on. I don't think anything's going to happen this year with it, but as rates go up and up and up, right, that's something that could get brought back to the forefront at some time.
And internationally, the US has quite high interchange rates compared to other countries, correct?
Oh yeah, probably. I mean, if not the highest, one of the highest in the developed world, for sure.
Thank you. Next question is, are you seeing merchants adopting Visa tokens? In what ways?
Absolutely, yeah. So I think where they prioritize or what merchants are implementing Visa tokens really goes back to this first bullet here, being able to track and manage it. The ones that we're seeing really push for Visa tokens are the ones where implementing Visa tokens saves them millions, right? Some even $5-10 million a year can save through implementing Visa tokens. So Visa tokens really are going to help you from an interchange perspective if you have a large card not present consumer credit card portfolio. So if you have a lot of volume in that space, absolutely, we see a lot of clients pursuing this, right? It's one avenue they can pursue that's really going to directly lower the interchange costs, and where it's impactful enough for them, that's where we're seeing that for sure. So there are other benefits too from implementing Visa tokens in general, right? You get higher auth rates, a little safer transaction. But by and large, the ones that we have seen so far pursue Visa tokens are the ones where the financial benefit is impactful for them.
Next question is, what are some steps merchants can take to reduce card costs?
I think I would look through this slide right here, right? So all these things, right? You can talk to your acquirer, you can talk to Optimized Payments, right? A consultant like us, we can help really dig into your data, right? Each merchant's gonna be a little different, right? You can't really answer that question without understanding and being able to measure and manage the data. But the items I have here are kind of top of mind, high level, right? More common items that could be pursued. But it goes deeper than this too, right? So a lot of people could be doing this, all of these things, and still have ways to optimize and reduce their card processing costs. So a lot goes into that question, right? But I would say the answer there is really buried in the data, right? Being able to dig into that data, understand the data, measure it, and see where other things could be changed to lower costs. So, but if you're doing everything on this slide, right, I think you'd be doing better than most, right?
And it's depending on what industry the client's in.
Yeah, a lot of, yep, exactly. Each industry is gonna be a little different, right? Even merchants within the same industry are gonna have different dynamics. So tough to answer across the board, right? It really depends on the merchant.
Thank you. Next question would be, could surcharging, that's something we haven't really talked about too much during this presentation, could surcharging be considered a best practice?
It could, absolutely. I didn't go into surcharging here because really, right, surcharging, right, let me answer real quick, is basically charging a fee to the consumer making a payment. It can be up to 3%. So you can go pay by credit card, but if you do, you're going to pay an extra fee up to 3%. It's supposed to be only on credit cards, not on debit cards. So that's essentially what a surcharge is. And could it be a best practice? Absolutely, right? So you would see this, it's becoming more and more common on smaller merchants. So just around the town I live in, a lot of those kind of smaller mom and pop restaurants and retail stores are going to have surcharges already, right? So they're basically still want to accept credit cards, but they're shifting that cost burden onto their consumers that want to use them. I didn't put as a best practice here because by and large, larger merchants have not utilized that yet. I think they're going to be more reluctant to ruffle their consumer base, but could it come, over as time, right? Could we see more and more larger merchants start to implementing surcharges? Yeah, that wouldn't surprise me at all.
And then did you talk about the July 1st changes at all? Did we bring that up?
I did. We talked on it on the econ debit routing. Yeah. So one of the best practices, and it's here too, right? Best practice debit routing. So in July 1st, right? So going back to last year, historically, in the card not present space, pinless debit routing, this debit network, Star and Ice, Pulse Excel, etc., have not been available to card not present merchants. The way the issuers kind of interpreted the Durbin Amendment, they carved out card not present. The Fed, after a long review, kind of stepped in last year, announced that that's got to change. The Durbin Amendment's supposed to apply to card not present the same as it does card present. So the Fed announced last year that starting July 1st, the card not present space must have two competing debit networks on every card. So starting July 1, you see we should start seeing pinless debit adoption increase significantly. Right now, if you're a card not present merchant, on average, only about 35% of your debit cards could actually go to a lower cost debit networks. That should start to approach 100% starting July 1st, right? So it's a big potential opportunity out there, particularly in the e-com, the card not present space.
It won't be there immediately though, correct?
Right. Yep. So
it's
supposed to start July 1, right? And as more issuers kind of enable the cards, right? They're all supposed to have it on July 1, but you're right, Tom. It's going to take some time. Also, what's going to take time is the acquirers all have to be kind of programmed and coded for that. Some will be, some won't be on July 1st. That's probably what's going to take more time than actual having the cards flag themselves. So it'll take time for the acquirers to be able to handle that kind of transaction.
Thank you. Another question that we have is, at what level of transactions or sales are needed to negotiate directly with the brands?
Well, that's a good question. I know if our colleagues are on, I don't the actual dollars of sales. I don't want to throw out an amount, but it's large, right? It's billions and billions of dollars in sales. I want to say $2 billion in sales, maybe. Don't quote me on that. We can follow up, Tom, with a better number, but really the brands are only going to work with significant size merchants. So again, offline, we can follow up with a better kind of general as the sales numbers.
Thank you. And that is all we have for questions. Tag?
That's great. There's a lot of questions,
yes.
A lot of good feedback. So.
Absolutely.
I would close. I hope you found this valuable. I hope you've learned something about maybe card processing costs that you didn't know before. And I think that, like I said, that 10-year, that 12-year trend was really striking to me. I probably hope it was striking to you. Hope you learned something from that. And knowing all that, right, maybe you have some ideas now of how you can help combat that, right? What you can do within your business, whether it be an item here or beyond here on the slide, right? Even with all the changes that are happening in the industry, the new fees, right? There's still stuff that can be done to lower your processing costs.
Thank you. Thank you for your time, Tag.
Thank you for the time.
Thank you,
Tom.
joining.
Thanks everyone for joining. Hope you enjoyed it.
Enjoy the rest of your day, everyone.
Yep. See you guys. Thank you.
Bye, everyone.